Welcome to The Explainer. Okay, today we are unpacking something absolutely monumental. We're looking at the behind-the-scenes preparations for what is quickly shaping up to be the single largest initial public offering in human history. SpaceX is currently targeting a valuation of $1.75 trillion. To put that sheer scale into perspective, that would make SpaceX worth more than every single American defense contractor combined. It's a completely unprecedented financial event, and we are going to unpack exactly how this is all supposed to work.
Okay, let's dive right into this. A $1.75 trillion valuation is, frankly, almost impossible to wrap your head around. We are talking about a market capitalization that is larger than Coca-Cola, McDonald's, Disney, Nike, and Starbucks, literally all put together. It's actually larger than the top 10 companies on the London Stock Exchange combined. It's just massive.
But, a number that massive immediately begs a really practical question. Who exactly is buying SpaceX? Because here is the wild reality we're going to explore today. This is a company that lost $5 billion last year. Who out there has the capital, let alone the willingness, to absorb a mega IPO for a company operating at a multi-billion-dollar loss? Well, shockingly, the answer might just be you. Because within a few weeks of this listing, your passive retirement account is positioned to become one of the absolute biggest buyers of SpaceX stock.
So to really get a grip on this, we need to start deconstructing the valuation, because we are actually looking at three entirely different businesses rolled into one.
To actually make sense of a nearly $2 trillion price tag, we have to peel back the layers. Because SpaceX isn't just a single company launching rockets. If you ask most people out on the street what SpaceX sells, they're probably going to say rockets or Mars exploration. But look at the revenue breakdown for 2025. This brilliantly illustrates the reality. Starlink makes up a massive 61% of the revenue. The famous rocket business? That's only driving about 25%. And then there's a 14% slice primarily driven by an AI acquisition. To figure out this IPO, we really need to take a quick look at each of these three distinct slices.
Let's start with the namesake, the rocket business. This is the part that gets literally all the media hype. And they do incredible, highly visible work, right? Launching US government satellites, running crewed missions for NASA, delivering cargo to the ISS. But financially speaking, they generated roughly $4 billion in revenue last year, which, don't get me wrong, is a ton of money. But as we just established, it represents only a quarter of their total revenue. On its own, a $4 billion revenue stream absolutely cannot come close to justifying a nearly $2 trillion valuation. No way.
So we have to look at the second business, the one that's actually paying the bills, Starlink. This right here is the crown jewel of SpaceX. It's essentially the answer to the question, what if Comcast, but in space? It launched in beta back in 2020 and has quickly become the fastest scaling telecom company in human history. They've got over 10,000 satellites beaming high-speed internet down to these little dishes on roofs all over the world. Entrepreneur Scott Galloway recently called it the best tech product of the last few years. And the market clearly agrees, because they just crossed 10 million active subscribers across roughly 150 countries.
Now, what's really fascinating here is the sheer velocity of Starlink's financial engine. In 2025, Starlink alone brought in $11.4 billion in revenue. But look at the efficiency underneath all that cash. 2 years ago, their profit margins were sitting around 41%. This year, they've expanded to a whopping 63%. Adding over 20 points of margin expansion in just 2 years is nothing short of incredible. And it's not even just consumer internet anymore. They've expanded to maritime shipping, commercial airlines, and even a highly classified defense version for the Pentagon called Starshield.
Okay, so you've got a rocket business doing solid work and a satellite internet business essentially printing cash. But then we get to the third slice of the pie, xAI. This is the AI lab founded by Elon Musk in 2023. Just a few months ago, SpaceX acquired xAI in an all-stock deal that valued the AI lab at an eye-watering $250 billion. The problem here? xAI was founded with 11 brilliant co-founders. By March of this year, every single one of them had walked out the door. The company was reportedly burning over $1 billion a month, and it was publicly admitted that it had to be rebuilt from the foundations up.
When you stack these numbers up against the rest of the industry, the disconnect is glaring. OpenAI brings in $24 billion in revenue and is valued at $850 billion. Anthropic makes $30 billion and sits at a $400 billion valuation. xAI, it estimates just $1 billion in revenue, yet it was bought for $250 billion. The market is basically pricing xAI like it's Emirates Airlines, but in reality, it's operating more like Spirit Airlines. xAI is essentially acting as a reverse Jerome Powell here. Instead of printing cash, it takes whatever cash Starlink and the rocket business generate and just lights it on fire.
And all of this brings us to a pretty harsh reality for the consolidated balance sheet. In 2025, Starlink and the rocket business brought in roughly $8 billion in profits. But because of XAI, the consolidated company of SpaceX ended up losing nearly $5 billion last year on roughly $18.5 billion in total revenue.
Let's move to and see how this builds into our next big piece of the puzzle, changing the Nasdaq rules.
Because the real story of this IPO, it isn't actually about rockets or satellites. It's about how the financial system itself is adapting right before this historic listing happens. On May 1st, Nasdaq adopted sweeping new rules that objectively roll out the red carpet for exactly this kind of IPO. There are three main pillars to these Nasdaq fast entry rule changes. First, they dramatically compress the entry timeline. Second, they remove the minimum free float requirement. And third, they introduced a really complex hidden multiplier for low float stocks. Now, being included in the Nasdaq 100 is absolutely crucial because there are over $600 billion in index fund assets that track it. Once a company gets added, those passive funds are mechanically forced to buy the stock.
To see just how perfectly tailored this is, let's compare the old rules to the new ones. Previously, a company had to wait 3 whole months to be added to the index, which allowed time for the market to discover its true price. Now, that waiting period is compressed to just 15 trading days. 3 months of price discovery squashed down to just 3 weeks. Furthermore, companies used to need a 10% minimum free float, meaning 10% of their shares had to actually be available to the public. SpaceX is reportedly targeting just a 4 to 5% float. Under the old rules, they flat out wouldn't qualify. Under the new rules, that minimum is totally gone.
And then there's the hidden multiplier. This little gem is very deep in the technical language, but man, it is incredibly powerful. For companies with a free float under 20%, Nasdaq now treats that float as if it were 3 times bigger than it actually is. So SpaceX's targeted 5% float, it gets weighted in the index as if it were 15%. This functionally means that ETFs are legally required to treat the available supply of shares as 3 times larger than reality, which systematically manufactures a massive wave of demand from passive funds.
Which brings us to the final piece of the strategy and where this hits closest to home, the exit liquidity strategy. We've just seen how the rules were rewritten to force index funds to buy in rapidly, without deep price discovery and at highly exaggerated weightings. Now let's look at who is actually supplying those shares on the other side of the trade. Most standard initial public offerings allocate maybe 5 to 10% of their shares to retail investors, everyday people. SpaceX is targeting a massive 30% allocation to retail. In fact, SpaceX's CFO told a roomful of bankers that they are doing this because retail buyers have historically been incredibly supportive of them and of Elon Musk. But functionally, what this means is the largest IPO in history is dumping a massive supply of shares directly onto retail buyers who might be buying based on brand loyalty rather than standard price stability metrics.
So the crucial point is really captured perfectly by portfolio manager George Noble, who said, "Your 401 is the exit liquidity. The buyers and sellers in this IPO aren't showing up at the exact same time on a level playing field. The buyers, meaning your passive retirement accounts, are forced in early and heavily weighted because of those new Nasdaq rules. Meanwhile, the sellers, the early insiders who are sitting on a very low-cost basis, are able to transfer their shares over to passive funds and retail investors at an absolute peak valuation."
We've always been told that passive index investing is the smart, low-fee, set-it-and-forget-it way to build wealth, and for the most part, it absolutely is. But this explainer reveals the hidden side of that pitch. The exact same mechanism that automatically buys the whole market for you also buys whatever gets added to the index, completely without your input. So I'll leave you with this to think about. Is the very convenience of passive investing secretly transforming your retirement account into guaranteed exit liquidity for any mega corporation that can get the index rules bent in their favor? Thank you so much for watching, and keep asking the right questions.